Hello guys and welcome back to the channel. So today is going to be an interesting video because we're going to be talking about what I believe is Jeremy Financial Education's biggest mistake, and that is Tatooed Chef. So as I said, everything has fallen so dang crazy that some stocks that were very overvalued start at very attractive valuations. I want to look at this Tatooed Chef. I never looked at that company. I was somehow never interested in it. And I did my own little calculation and I want to share that with you. So if you like this content, please make sure you hit the subscribe button and the like button. And if you want to support the channel and get access to all my stock valuations that I cover on this channel, it's $5 per month and it's the first link in the description. And I don't believe I have any Patreon supporters yet, so you could be the first one. It would be amazing. So let's get into the video. As a first thing, I want to say that I really like Jeremy. I still watch him every day. In my early stock market days, I still love his positivity. You know, even after a red day, he's always focusing on, how we must be close to the bottom and, you have to buy the dip. In general, I very much agree with his sentiment. And obviously, he's very, very much down. I actually am going to make a video about how much he's down. He said it in his last video that it was about $3 to $4 million. However, everyone is also down very significantly. Tom Nash is down. Meet Kevin is down. Kathy Woods, don't even talk about Kathy Woods. Jim Cramer, pretty much it's only Warren Buffett who's up. And funny enough, my wife, who did a stock market course with me, and she started trading on paper, and she started in the worst possible time on the stock market, and she's somehow 0.5% up on her paper trading portfolio. Boy, I wish that she would have taken care of my own real portfolio. Anyways. So that's beside the story. So keep it in mind that it's not a Jeremy problem that he's down. It's like a macro problem. And then another thing that many people don't understand is Jeremy is a very, very long-term investor and he doesn't need all his bets to work out. And I believe that he knows this. He obviously doesn't have all his eggs in one basket. But think about this. If every stock that he's buying, he thinks they're going to 10 or 20x, and let's say he buys 10 stocks and he's right only on one of them. So one stock, 20x is his money. I believe it happened with Tesla on him. I watched him invest in Tesla. It was a genius investment. And then let's say that 5 of the stocks out of the 10, 50%, let's say they do between 3 to 4x over, 5 to 10 years. And let's say 3 don't go anywhere, and then on 2 he loses all his money. His portfolio is going to be still way outperforming the market and way, way, way up. So he really doesn't need any one of his stocks to go well, as long as he has some in his picks that are going to 10x, and he's looking at a very big variety of stocks, and I believe that some of them will 10x. So this is definitely not going to kill him. So let's talk about Tatooed Chef. Tatooed Chef is a vegan food producing company. They're very new, and on the surface they do look very good. They have a very big year-over-year revenue increase. I believe you can see it here. In 2019, 80%, and then 74%, and then 43% in 2021, and a question mark on what they're going to do in 2022. So far so good. Then, because I watched Jeremy's videos, I know that they're coming out with lots of products and they're taking market share from different companies. However, there is 2 things that super much bother me about this company. And one of them is that their gross profit is crazy low. It's about 10% of their revenue. You can see here that they made 84 million and 13 million. This is maybe a 15-17% gross profit margin. Again, for example, a company, I know it's not even comparable, but let's say Palantir, a stock that I really love, they have it at 80%, which means that if they get 1 million in revenue, they have $800,000 left to pay all the employees, all the administration, all the marketing. Whereas TTCF has, they sell 1 million and they have 150,000 left to pay all the employees, pay all the marketing, reinvest into their business. And you can see that their gross profit even declined from 2020 to 2021. And here it's about 10%. This is very, very, very low. So this is where Jeremy probably knows something. They are probably working on expanding this gross profit margin, but I don't know. So here is their outlook for 2022. You can see they're coming out with way more products. Very good. They have more distribution. Very good. And they have their full year outlook. So they're guiding for this much in revenue. Again, a gross margin of 10 to 12%. So that means that they will have $28 million left to pay all the administration, pay all the marketings. And you see, just on the marketing expenses that they're saying they will go minus, and they haven't paid a single employee, a single factory worker, and so many other things. So then the next thing that is really, really troubling for me, and I need to basically show this to you here, is if you look at their balance sheet, you will see that they have $50 million on account. They don't have a lot of debt, which is really good. Okay, this was the end of the year 2021, but if you look in their financial reports, here you will be able to see that at the end of Q1, they had 50 something million on their account. Let me show you here, cash, 57 million. Again, they're pointing to that they have accounts receivables. Fine, let's give it to them. But here's the real troubling thing. You look at their cash flow statement and you will see their cash burn is increasing, obviously, because their gross profit is so low. And when your gross profit is so low, when you expand, obviously you expand your losses. And you see in the trailing 12 months, they burnt about $82 million. So this means that if you look at how much cash they have in the bank, which is 50 million, they will burn through it in 6 months. If you even add to it the bills that are outstanding that they will get paid into them, then they have 1 year and they will need to take on debt or they will need to dilute the shareholders. I think on the long term, it's better to dilute the shareholders and not get debt. But the stock price is super much down. So that means that they're going to mega much dilute the shareholders. I think normally companies want to raise about 2-year runway. And if they're burning 80 million a year, 2 years is 160 million. Their current market cap is 500 something million. So that is almost a 20% dilution that is coming for them. This is a very big unknown. Maybe it's not 20%, but they will have to take a loan or something, right? So now let's create a valuation model. So here's my valuation model for TTCF. And here's the numbers that I have. So they have a market cap of 596. They don't have any P because they don't make positive earnings. Their free cash flow is minus $68 million last year. So basically the only metric that you go on is a price to sales ratio, which is 2.79. So if you just look at this compared to tech companies, it's very, very cheap. I don't know, because this is my first food company, I don't know how it fares against food companies. But again, because the gross profit of food companies is probably very low, it wouldn't surprise me that this is not cheap, or maybe this is, I don't know. But the point is that obviously you can't compare this to Palantir. Again, they don't have a PEG ratio, or it's a minus PEG ratio. They have an 82 million share count, and I'm projecting that they're growing 35% per year. Again, this is also a big question mark. I believe that Jeremy must be banking on that the world is going to go vegan, and this is a very big 10-year trend, and they are going to accelerate way more than 35%. Yeah, I don't really see this in the numbers. So, and I believe that this is also, like, he even says it in his videos that, food companies expand maybe 5-6% a year, and that's like a high number, right? So let's count with this 35, and we add up. I'm just gonna make my face bigger. Hello. Again, 2021, it's very hard to give any metrics because they made a minus. If they magically, but again, this is impossible already based on their guidance, but let's say magically they start making profit in 2022. I know it's nowhere written, but how much profit can they make if their gross profit margin is 10%? I believe even 3% is very, 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 very high calculated, right? And then I'm giving them 35% every year up to 2025. And here's the thing. So we saw that they're running out of cash. So they are going to have to do a share dilution. And at the current stock price, if the market is not changing, the share dilution would be epic big. I mean, they would dilute the shareholders to the ground. I'm gonna show you if by some magic they don't have to dilute the shareholders, what would happen. But this is what I see. I mean, a very big risk, at least. It's not guaranteed, but you have to count with this, right? And then, you know, I'm counting with 3% a year stock dilution for, you know, employees and stuff. This is a bit of a speculation, right? So if my calculation is correct and they start making this 3% profit, then they will have an operating income of 21 million in 2025, which would give them a market cap of 1.5 billion if the PE ratio goes up to 70. This is also a very big question mark to me. I don't believe that a food company can get a 70 PE. Again, you see the result is significantly different if the PE is 50. I'm trying to see what Jeremy sees in this, okay? So this is a positive calculation, okay? So with this, if the market cap is 1.5 billion and this is the number of outstanding shares, then you will have a share price of 14 in 2025 and 54 in 2030. Here's the deal. If you are fine with 20% return per year, then to arrive at this 14 in 2025, the share price should be 6.68. The current share price, if we look on Yahoo Finance, is 7.24. So it's even higher than this. Let me see, based on my calculation, 18. So you would have a compound return of about 17% per year. This is your, I believe it's an optimistic calculation. So this is counting in that they're growing 35% per year. This number I'm okay with, but it's calculating in that they have this 3% profit rate and that the market gives them a 70 PE. If the PE is, I don't know, 40, way more conservative because this is not a tech company, the share price in 2025 would be 8. I don't see what Mr. Jeremy sees in this stock. I am not okay with the 17% return per year. So now I want to make this calculation work and I want to see what would make it work so that we understand what Jeremy is banking on. I'm pretty sure that he would say that the stock dilution is not going to happen. I believe that they need to pull a rabbit out of their hat for this stock dilution to not happen. They have to have some solution on, they have to take on debt or something, or I don't know what, right? Then they need to significantly increase their gross margin. As far as I understand from this video, they're working on something like this. So let's give them a 5% profit margin. That's very high. Give them the 70 PE and we give them the 2 PAG ratio. Then the market cap would be 2.5 billion and then you would get a compounded annual 30% return at $9. So then the price is really attractive. So this is probably what Jeremy is banking on, but I just don't see it. I don't know how they make it through this cash burn. I don't know how they increase their profit. So I believe that this company is the future will tell, but I don't see the same thing that he sees. However, I still like him very much. He's an amazing YouTuber. I believe he's an amazing investor. You don't need all of his investments to work out for him to be a good investor. Not all of Warren Buffett's investments have worked out. Let me know what you think in the comments. Do you own TTCF? I will see you in the next video. Bye-bye.